Welcome to PhillipCapital's Weekly Market Watch. It is known to all that while economic conditions have improved, there remain hurdles to cross. What are these hurdles and how will they affect the performance of equities? Today, we have Ms. Hilary Ho, investment analyst from Phillip Securities, to share with us. Hilary, could you provide an update on the economy?
Key economic indicators continue to be on an upward trend. The ISM Manufacturing Index, for instance, registered 52.6% in September. This is the second month of expansion following 18 months of decline. So in line with that is the increase in production. So with the exception of the utilities industries, production in the manufacturing and mining industries increased approximately 0.8% in September from the previous month. Gradual improvement in economic activities has led to the decline in initial jobless claim. As of the week ending 17th of October, the number of people filing for unemployment claims for the first time declined as much as 21% from the peak seen in March. The number fell from 64,000 people to 53,000 people.
While most believe the worst is over, concerns of the economy continue to exist, one of which is whether Fed will increase interest rate following the move from Australia. What is your opinion on this issue?
Okay, Australia raised its interest rate for the first time since the global financial crisis started more than a year ago. The benchmark rate rose a quarter percentage point to 3.25%. While it is the first country among a group of 20 nations to increase the benchmark rate, the Bank of Israel was actually the first central bank to increase rates in August. While economic activities have gained pace, the first rate hike might not take place immediately in the States. This is because the economic conditions and financial health of both countries do differ. Okay, for a start, Australia experienced negative growth for only one quarter, while the States had 3 quarters of negative growth. Secondly, month-on-month percentage change in the amount of loans granted in Australia was generally positive. The States, on the other hand, had experienced negative month-on-month loans creation for several periods during the crisis. And thirdly, Australia's economy is closely tied to China as it supplies the materials and goods that the country requires. So with emerging economies expected to contribute significantly to global growth, developed countries with exposure to these regions will stand to gain. At present, the Fed fund rate is effectively zero, so as such, even if the Fed were to raise rates by 50 basis points, the Fed fund rate will still be at a historical low and thus continue to be stimulative in nature.
That seems to suggest that although there remains concerns on the economy, these negatives are not dire at the moment. So how will companies' earnings and valuations in turn perform?
Although threats to the economy still exist, these negatives are not dry at the moment. On the other hand, the continued improvement in economic data could provide the uptick in demand necessary to lead to an expansionary cycle. In turn, that could improve companies' earnings and also satisfy investors' search for actual revenue growth. In addition, it will aid to reduce some valuation concerns that have developed after the stark movement in stock prices since March.
Does this in turn imply that upward momentum for equities is still intact?
Compared to the time when the rally first started, conditions have improved, and companies like Alco are reporting an increase in earnings attributed to revenue growth and not just cost-cutting measures. As such, that provides some basis for the long-term upward trend for equities to continue, and also reasons for investors to remain exposed to equities. However, having said that, a near-term correction remains possible.
Thank you, Hilary. That's all we have for you today. Tune in next week for more market updates.